Williams. I'm Sales Director at Pepper Money. I'm delighted to introduce our autumn edition of the Adverse Credit Study. This year marks the anniversary of our first bout of research so that we can start to understand year-on-year trends of how adverse credit is affecting borrowers. Plus, we've added in a new set of questions to help the industry understand the impact COVID-19 has had on borrowers, especially those who have already experienced adverse credit in the last 3 years. As part of the launch, we invited some of the most influential and experienced stars of the specialist mortgage market to have their say on our latest findings. Thank you all for your valued input and hope our viewers enjoy the full study.
The report states that over 2.1 million people missed a payment in the last 6 months, and half of those were multiple missed payments. And now more than ever, I think it's a massive opportunity. People need our advice and our guidance. And they may need to understand specialist lending because there's a lot of people that understand the high street guys, the household names, but they may not actually understand that there are specialist lenders out there who can help them, especially in the short term.
Increasing numbers of people with adverse credit are going to be seeking advice in the future, and the current uncertainties in the market, including the ranges of products available, will surely make it more important than ever that people do get expert professional advice. Those responses certainly reflect confidence in the property market and the ability to repay the loans taken out.
The biggest misconception that the study helped me understand actually was that adverse credit used to affect the ABC1 group more than the C2DE. That trend apparently has finally flipped in August this year, if by a very narrow margin. Also that the 35 to 44 age group has emerged as the most common for people who have experienced adverse credit in the last 3 years, not those in their 20s or younger, perhaps as I would have expected.
I think certainly there is a misconception, and the study tells us about the misconception and the disparity between the client's view of their ability to be able to get a mortgage and the reality of actually whether they are able to, and in fact more clients not getting declines when they thought they actually would do.
The most surprising statistic within the study is what Pepper calls the misconception gap. That is, that nearly 70% of potential home buyers who have adverse credit are concerned that their adverse credit will result in a declined mortgage application. However, of homeowners who have had adverse credit in the past, only 7% said that their adverse credit resulted in a declined mortgage application. This is a misconception gap that we need to address as an industry.
Just over 1 million people are affected by adverse credit, and this seems to have come down compared to where we were only a few months ago. Is this a positive sign? Is it not? I think on one hand it is. I think people certainly through COVID have potentially been able to save money. Those customers that have taken a payment holiday have maybe sort of kept hold of that money or found other ways to better utilise it to potentially pay off any debts. Other customers though, which we need to be cognizant of, may have struggled through this period of time. So actually, on the other hand, I do think this number is potentially a little bit lower than expected. I do see more customers having some form of difficulty, maybe missing a payment through the COVID time as income has become harder for some. And that will lead for a greater need for access to lenders such as Pepper and others within the specialist lending field.
Of the 66% of clients who would seek advice from a mortgage broker, 53% would base which broker they would approach via online research such as Google and reviews. What this highlights to brokers is that they not only should have an online presence via their websites, but also actively encourage clients' feedback in a way that enables the broker to distribute through online review platforms.
I was interested to learn that adverse credit has actually fallen in the last 6 months from doing that, but when you look at perhaps why that is, when you see that incomes, there's been a bit of a decrease in income during COVID-19 for some people. I think people are watching the purse strings. It's not about keeping up with the Joneses anymore. It's about looking after what you've got, appreciating what you have. And it was also good to see some people were paying off some of the debts as well, so debts weren't increasing.
The one area which really stood out for me when reading through the report was the impact the pandemic has had on people's level of debt, with 77% of people stating their level of debt has remained the same or actually increased throughout this time. This is a statistic that's worrying on its own, let alone without adding the impact any decline in income may have had on people's circumstances.
Perception is not reality. 27% of the sample group believed that if they had a CCJ, they'd have to wait at least 5 years before they applied for a mortgage. And an additional 34% of the respondents just didn't know how long they'd have to wait. So you think that's in excess of half the market. As I mentioned previously as well, perhaps unsurprisingly, 69% of the respondents believe that as a result of COVID, it will get more difficult to get a mortgage. But here's the reality. Only 7% of homeowners, according to this report, who had experienced adverse credit before applying for their current mortgage, say that adverse credit resulted in a declined application. And I was quite surprised that that figure was as low as it was.
From a broker's point of view, having looked at all the stats and everything, all the information contained within the study, it's good news for brokers. From the last 3 years, who may be looking to purchase in the next 12 months, up to 66% of those people would opt for seeking advice from a professional. I think that's key. It would be great for a broker. The information within the report will be great for a broker because it also outlines some of the issues the clients are having and just enables the broker to be a little bit more vigilant and have a little bit more understanding of what those issues might be and perhaps why.